Welcome to This Week in Mining, where we focus on making money in the metals and mining sector. I'm your host, Jay Martin. This is normally a live show. I'm going to begin this week with an apology. Today, we are not live. I am in Las Vegas at a conference, learning a bunch of stuff on video content strategy, which I'm super pumped about. But today, I've got two amazing guests. So just for context, this episode was recorded on April 17th, so about 6 days ago. And a world can change in 6 days. So we're going to keep this as evergreen as possible. And my mission today is to offer a boot camp in picking winners in the junior mining business. So what I've done today is invite two good friends of mine who have been some of my go-to brains that I like to steal ideas from. If I'm excited about a thesis or an investment concept, I've got two gentlemen on the show today who have just crushed it in every gold market. And so I'm very, very excited to share their brain capital with you guys today. And they are Jeff Clark, whichever side of me he is on right now, the Pay Dirt Prospector, longtime guest on my show. And, you've been on a handful of times, Jeff, and also at my events in Vancouver in January. So thanks for making the time today to join me. I'm very grateful for that.
Yeah, thanks for having me, Jay. I'm looking forward to this.
And Jamie Keech is back for his second tour on This Week in Mining. Jamie's the author of Resource Insider, close friend, again, somebody who's crushed gold markets of the past, made me a bunch of money. I appreciate that, Jamie, and thanks for coming on today.
Thanks for having me.
So let's start here. Gold's ripping, and it's catching headlines on mainstream media. And I'm watching programs like NBC and Yahoo Finance suddenly, and you know how this happens, right? When there's movement in the market, media pundits then add logic to it. And they say, oh, gold is taking off because of all the global conflict, or it's taking off because of the economic turmoil, as if that wasn't the case like 2 years ago. These things have been going on, right? Now gold's running, but we're meaning-making machines. We got to apply logic to it. Jeff, I want to throw it to you right away here, because you're in this market, you're in this industry, good markets and bad, right? You're allocating cash all the time. What are you paying attention to right now? Gold sector, macro, what's real and what isn't? What are you watching?
I'm not paying attention to any macro right now.
Interesting. Okay.
I say that tongue in cheek because so back in the day when I started at Doug Casey's firm, one thing he really impressed upon us is, look, you don't make predictions, and you don't make predictions with a timeline. And, being new back in the day, I started doing that. And of course, you're wrong most of the time. Most people are wrong most of the time. Even analysts who do this for a living are wrong a lot of the time. So I pulled back from that, and I realized that if I would just focus on gold itself and the best mining stocks that I could find, that 9 times out of 10, the macro picture didn't matter. Now, of course, at times it did during the 2008 crash, the COVID crash in 2020. But even then, I used those, especially in 2020, I used that to really load up on stocks and on gold, and especially on silver at the time. And that was very profitable for me. So I've learned from that. And so I'm really focused just on gold. Even in our letter, we don't even talk about, the commitment of traders report, what the economy is going to do, what the Fed's going to do. Is there going to be a recession? Oh my gosh, No, we're just focused on the very best mining stocks that we can find, and making sure that you own enough physical gold outside of the banking system. So I found that by doing that 90% of the time, I'm going to be better off financially. My portfolio is going to be better off than if I try to worry and fret and guess and predict and forecast what's going to happen next with this or that. And actually, that's a good thing about gold is, it can respond to so many different factors. That's a lot of the media thinks they're experts now with all these articles that are coming out, but these are basically journalists that are looking for content, and they are not really familiar with the gold market, and they're pointing at this and that, and it's really not doing us all a good service. The great thing about gold is you can own it, and it'll protect you against almost any kind of uncertainty, whatever that uncertainty may be, even black swans. And so that's what I'm focused on, and that's why I'm not paying attention to many macro factors right now. Now, of course, I watch what the Fed's going to do and the economy and interest rates and all that jazz, but it doesn't really, at the end of the day, impact some of the decisions I make about what I'm going to invest in.
I find that so refreshing because there's a media mission that exists every day, and then there's the investor's mission, right? And those things do not serve each other. And even publications that I really appreciate. I mean, I read the Wall Street Journal. I think it's quite good, but they have a job, and their job is to find headline news every morning and every afternoon. And as we know, there isn't headline news every morning
Right.
and every afternoon. They'll find something and they'll sell it as headline news,
Right.
you know, and then we respond to it. And as a consequence, investors are hyper reactive, right? Which does not serve, go ahead, because we're long-term value investors in this sector. Jeff, please.
Well, I was just going to say, not to hog the time here, but I was at a conference. This was right before COVID hit, and I was at a company dinner. We'll leave them nameless, but they invited, some hedge fund managers, family office managers, some newsletter writers like myself, and I struck up a conversation with a gentleman who was a hedge fund manager, and we started talking about gold versus being invested in the main stock market, the S&P. And I said, well, come on, he was kind of debating me a little bit because he knew I was kind of a gold bug. And he said, well, come on, the S&P's outperformed gold. And I said, are you kidding me? I said, gold has outperformed the S&P century to date, and again, this was 2020, but still 20 years. He didn't even know. He actually started laughing at me. And this is a hedge fund manager, someone who's managing money for a living. He didn't even know that gold was trouncing the S&P. It still is. And he didn't know that. So I'm really curious if he still has his job. But that shows you like a lot of misunderstandings that are out there. And he's a broker. He works in the industry and he didn't even know that.
Jamie, I want to pass the same or similar question to you. When it comes to macro signals, macro news, do you have your head up and eyes open? What are you watching? Or are you detached from that and you focus on your thesis similar to Jeff?
So you made an interesting point in your introduction where you said, what, people are just waking up right now to what's going on in the world with changing events. During COVID and since that time, we've had war, we've had plague, we have had talk of famine. There's been, the 7 horsemen of the apocalypse, and gold is only starting to move now. And, the question of why that is, I think can be answered with 4 letters: AISC. And for anyone that's ever read anything about a gold company or any mining company, that stands for all-in sustaining costs, which is the measurement of how much it costs to mine 1 ounce of gold. And that has been going up and up and up with inflation. Unsurprisingly, the biggest input for most mining operations is diesel cost. As energy prices go up, it gets more expensive to mine. As wages go up, it gets more expensive to mine. As commodities and infrastructure and all the inputs you need go up in price, it gets more expensive to mine 1 ounce of gold. And what I see happening, this escalation in price is like just an escalation in price of gold is a reflection of an increase in the cost of mining an ounce of gold. And I think that's what's driving it right now, because there are many, many mining companies, major mining companies right now, that are making less today at, what are we at now, $2,400 an ounce gold, than they were at $1,800 an ounce gold several years ago.
Yeah.
What does that tell you about the market? Meaning, like, could you qualify today's gold market as a supplier's market or a buyer's market? Because, one typically drives the other. And if there's enough demand, then suppliers can name their price.
So it's good to take a step back and think about that, right? Because, when you invest in most businesses, you're looking at their margin, right? And you think of like what a great tech business can do, and it can be 80-90% margin. A great manufacturing business or sort of traditional business, 40-50-60% margin. Traditionally, in commodities, particularly in mining, you see about a 15% margin on average across the cycles, and that's a really shitty margin. So to make 15% profit. So to put that into perspective, Costco, which prides itself on being the cheapest operator on the planet, has a mandate that they can only have a 14% margin. So basically the commodity industry operates like a Costco, and no one has to buy a membership to be part of the commodity industry. So it's traditionally not a great business, which is why so many people lose money in commodities. But what's unique about commodities is it's an incredibly inelastic business, right? So you all know this, most of your listeners will know this too, that when price escalation starts or when demand comes on, you can't turn a new mine on tomorrow, right? You can't just bring in that extra million or 100 million ounces of gold or pounds of copper or barrels of oil, whatever. Oil's a little less elastic, but particularly mining, it's very, very inelastic. So what you have then when that supply crunch actually hits, all of a sudden you get massive escalation in price to bring on that supply, and that's when investors can make a lot of money. So that's all kind of a convoluted long answer to, I think it is a buyer's market today of gold and gold equities. And the reason I think that is because gold companies are not making the profit margins they should. And at some point, price of gold has to escalate to incentivize that. That's my view.
So this is the beginning of that process. If I'm interpreting what you're saying correctly, you think that reckoning is coming. We're seeing, the gold price rally, but how far down that runway, if you were to speculate, Jamie?
I'm going to heed Jeff's advice there, which don't make predictions and don't put timelines on them. But listen, I've been buying gold stocks just this week, or last week rather. The reason I'm buying them is because I think gold price is going to be going up. So I know I'm directionally right. I don't want to put a timeline on it.
Yeah, I thought I could bait you there with a timing question, even though I never give forecasts myself. I appreciate
I've got it wrong so many times in the past, so I think I've learned my lesson at this point.
It's the best you know what? It is the best answer to that question. Is that I don't time markets, and I think that's so important because it's a long-term game, right? And typically, as a gold equity or silver equity investor, you're wrong before you're right. I mean, most of the time, right? And that's part of the game, and especially where the three of us play, which is in the early stage, the early stage companies, right? Exploration development companies. Jeff, talk about this, right? Is being wrong just part of the game? And then how do you manage that from a portfolio standpoint as a gold and silver equity investor?
Well, a long-term investment is basically a failed short-term investment, right? So that's more true than I think a lot of us in the junior sector would like to admit. But I think Jimmy makes a good point. We got the direction right. We know the direction that gold is headed, and it's got to go higher. How many risks have been washed out of the system because of the recent rise in gold? Literally none of them. They're all still there. All these risks are still right in front of us. The system is still very vulnerable in many ways. And so I think gold has got to go higher. For the gold stocks, they will follow, and they haven't been as of yet. Now, I say that, but I should point out that both GDX and GDXJ have outperformed gold since gold ignited, which was on the last day of February. I forget what the date was, 29th, I guess. That's when gold took off on that Friday. And since then, it's done very well. Since that day, GDX and GDXJ have actually outperformed it as of the time we talk. So they're doing okay. It's just that the juniors haven't moved like a lot of us thought they would. So the good news is that is still ahead of us. That's how I look at it. I still have an opportunity to buy what I think are some of my favorite stocks, some of the ones I think are going to be the stronger performers. In fact, that's my biggest fear, Jay, is that this thing's going to take off and I'm not going to have all the positions that I want or the full allocation in those positions that I want. That's actually a fear of mine, because at some point it's going to happen. History shows us this. History demonstrates this, that gold moves first, then the producers, then the smaller producers and developers and then finally money tricks down to the juniors. So that's still ahead. That's the good news. You still have time to really get involved in the market, get what you want before it really takes off. Because I really do think that's going to happen.
So where are you putting cash right now, Jeff? What part of the market are you most focused on?
Well, I certainly like gold. I think you got to have some gold stocks in there. In fact, I don't know what percentage, but that's a fairly sizable percentage of my portfolio is gold mining stocks, and specifically the juniors. But I'm also looking at copper. Some people are scared off by copper because they think we're going to have a recession, we're going to have a stock market crash. Maybe we do. The recession is debatable at this point. We'll get another recession someday, but it doesn't appear to be imminent, knock on wood, and a stock market crash. But if you look back through history, stocks in general, the S&P, the Dow, and that sort of thing, they usually rise during election years. So we have that historical precedent. Then the second thing is you have the fact that the Fed has said they're going to lower interest rates, and that is bullish for not just gold, but for the general stock market as well. So it's debatable if they really will lower 3 times at this point, but that's going to be the direction they go, right? So there's evidence to think that we may not be having a recession very soon, and we may not be having a stock market crash very soon, at least how I see it. And so therefore, I want to be long. And be in this market, and by that I mean the juniors, which are very volatile. And so, how do you counter that? What if I'm wrong and we do have a recession, or we get a stock market crash next month? What happens if I'm wrong? Well, that's why you have a big cash balance. It doesn't mean be out of the market. It doesn't mean be fully in the market. It means that you're balanced. So you have exposure to stocks in case they take off, and you also have cash to balance that. Irrespective of all that, I'm still focused on what I think are the best of best. And by focusing on the strongest stocks, I think I have a better chance of winning than by waiting on the sideline and thinking, oh no, is there going to be a recession? There's going to be a stock market crash. I don't want to own anything. Well, buy best of best, have some cash, and that's your strategy. That's the best we can do because we don't have a crystal ball.
So, okay, I'm going to pull on that thread and ask you to define best of best a little bit. Before I do, Jamie, same question over to you. When you look at the value ladder inside the precious metals equities, are you up with the producers right now? Are you looking at cash flow? Are you looking at developers, or are you going to the highest risk area, the explorers? What are you looking for right now?
So when I think about this, I'm taking into account a few factors. So Jeff is right that producers tend to move first as gold price rises. And I would say for the average person listening to this, you should be buying a basket of major producers and royalty companies, and you're going to get general exposure to gold swings. The challenge producers are having, I would say right now, again, is this inflation and is this rising cost. So there's some challenges that it's not that they won't rise in a rising environment, it's that it's not optimal. And then on the other hand, we have the very other extreme, we have the early stage exploration companies, which I've invested heavily in the past, and I've had some big winners and I've had some big losers there. And I would say now is not the right time to be investing in early stage exploration companies. In average, they're burning cash too fast, they're getting results too slow, and when they are getting positive results, those are not getting rewarded by the market. And to make money in an exploration company, you need people to believe in that company and to continue to buy the shares at higher and higher prices, and that is not happening now. It's going lower and lower, and they're diluting and diluting and diluting. That will change presumably at some point, but I wouldn't say today. Where I'm currently focusing and currently investing is in the development stage. So this is a project that has a real asset, that has a resource in the ground, maybe has a reserve in the ground, is starting to wrap economics and technical reports around that, either in the form of a PEA or a pre-feasibility study. You know you have something real, and you know you have something, in theory, if you're doing your due diligence right, that someone will want to buy at some point. Because right now you have the majors that have prioritized nothing but saving cash and returning cash to shareholders for the last 10 plus years, and they are running out of gold ounces. And eventually there's going to have to be an M&A spree, and they're going to have to buy these later stage development companies. And if gold continues to rise, you're going to have to buy them at a premium. In addition to that, the development companies are relatively inexpensive to operate. You know, they don't have huge teams of people on site. They don't have equipment operating. They typically just have some engineers working in an office somewhere and some drills turning, all of which can be shut down very quickly, very cheaply if they have to. So where I think I'm going to get the biggest bang for my buck, the most leverage, is in those development stage stories. That's what I'm doing right now.
Okay, I'm going to stick with you for a minute, Jamie. What can you share with us today on your diligence process? Is there any kind of a red flag checklist that you might walk through? I mean, I always tell people when they ask, you know, how to begin doing diligence on the ocean of companies that are available to a retail investor. Like at my show in January, we have 350 companies in the trade show floor. I often get people asking me, how do you begin talking to these companies? How do you begin finding, you know, the best of the best, as Jeff said? And I kind of take a different approach. I say, I don't know how to pick a winner. I'm far better at deleting the probable losers. And that's an easier game,
Yeah.
right? It's like, so I
Yeah.
identify the red flags and then cold-hearted no's really quickly. And whatever's left, I take a look at. What's your process, Jamie?
So I would say, well, first of all, I would say I feel for your listeners and anyone sitting at home who kind of has this idea, hey, I want to invest in gold companies, or I want to invest in early stage gold companies, because there's about 1 billion options out there, and how you find the good ones and sort through them is an overwhelming task. And I would say I have a really unfair advantage because I'm here in Vancouver and I'm from Toronto originally. So two nexuses of the mining industry. I have a huge network in both of those, and I'm a mining engineer as well too. So my first step is I'm mostly, and most people can't do this, I mostly talk to people that I know. I talk to other engineers, I talk to geologists, I talk to bankers, brokers, etc. And every day I am inundated with investment ideas and investment pitches. So I kind of do a first pass of who is this coming from, what due diligence have they done on this, and then what track record do they have at either investing in good deals or running companies or whatever it is that person does. So at this stage in my career, I am looking at very few things that do not come to me from someone that I would consider competent and reputable. So that's step one, and that's, you know, unfortunately for most people, not something they can easily do if they haven't spent a career in the mining industry. The next step is I do my own due diligence. You know, there's a large checklist, but it's not an easy checklist. So it's in-depth financial due diligence. It's in-depth technical, both from a geological and an engineering perspective. I do a lot of research and ask a lot of questions on the people and who they are and what their plans are and what they're going to be doing and what they've done in the past. I try to conduct site visits when applicable and when possible. And so it's a large, long, complicated process before we decide to invest. So that's on average what we do. For the whole, it's worked fairly well.
Jeff, same question over to you. What can you share on your diligence process? And maybe I'll emphasize here, you know, I gave a talk at the conference in January, 5 simple rules for any mining investor. I think rule number 3, very important to me, was build your team. And when I say build your team, I mean, find the personalities in the sector who are doing all that work that Jamie just discussed, that Jeff is about to discuss. It's the full-time job, and they've been doing it for decades.
Yeah.
And you can
And-
unofficially partner with those people via their businesses, right? You guys both have, individual publishing companies where you share your diligence and your portfolios with your subscribers. And to go it alone is, quite frankly, I'm just going to say it foolish. It's foolish. It's too risky of a game. Jamie, you were going to jump in there?
I was going to say, I mean, there's often this, like the 5 simple rules or the 10 things you look at. And well, that's a good highlight. You make a good point, is that if you fall into the trap of thinking that's all you need to do, you're at severe risk of getting burnt very, very badly. You know, mining is a hard business to make money in. It's very opaque, and very few people do consistently make money. Very few people who have spent their entire careers in the industry make money. And, you know, I would say, even for myself, I'm a pretty well-rounded technical person, but I do not rely on my own expertise in every area that I look at. If I'm looking at metallurgy, I'm not the person to make that decision. I talk to a metallurgist. If I'm looking at anything more advanced than moderate geology, again, I talk to geologists that are not geologists, but geologists in that specific type of deposit. So don't underestimate the complexity, the technical complexity of these things. And I think you make a very good point, Jay, which is like, find the people that can help you on that, because it's, there's a reason the biggest investment funds in the mining industry have hundreds of people working at them and not 2.
Yeah. Okay, Jeff, same question over to you. What can you share on your diligence process?
Well, Jamie makes a good point. Mining is a different business than evaluating Apple stock or Microsoft. Most people aren't familiar with it. Even many in the mainstream, even many that comment on mining stocks in the mainstream don't really know what they're doing, I can say. But there are certain things that you can do to really reduce the risk. And it kind of goes back to what you were saying, Jay, of finding the fatal flaws in each of these to get rid of stocks. And you're right, there's so many of them that, our initial goal is to eliminate them, not to try to include them. And so you're looking for fatal flaws all the time. And, I do use a method that has worked for me. And I share that in the book. It's very detailed, but it's to give the retail person a fighting chance to actually succeed in this complex and sometimes daunting industry. And I think by doing so, it's worked for me, all I can say. And it worked for Doug Casey. I pass along a lot of things there that I think can work. And I think most people in this audience know you can start with the 3 legs of the stool: is the people, the politics, and the project itself. And just doing that, you can eliminate 90% of the stocks. And the first one being the people. It has to be in that order. We've talked a lot about this before, but one thing you can do that's very specific, that can tell you if you have something or not, and that is to ask the CEO a very specific question. What did the stocks do under your prior tenure? In other words, did they create shareholder value of the prior companies they ran? You can also do that with the geologist, the lead geologist. I don't want to give any names, but you could pick someone out that has had 5 discoveries in his career. Well, you've already got someone who you've got a good shot at investing in. Whereas the person who was running a marijuana farm last year, that's not the best person to invest in. But just look at the stock of the prior companies they ran. Did they create shareholder value? And then as far as the politics go, I'm very conservative, because we're already risking, investing in the most riskiest sector on the planet practically. So why take on more risk? So I'm very selective about where I invest politically. You can eliminate a lot of companies just on that basis. And then the projects themselves, they've got to be like my grandma's chocolate chip cookies. They've got to be big and rich, or have the potential to be so. So there is a lot involved. Jamie's right about that. But I think a retail investor can learn enough to identify some potential winners as long as they have a basket, because even Jamie and I, we've been saying we're not going to be right all the time, and we do this for a living. And so you have to have a basket. You have, if you're going to invest in the juniors, you have to have 10. Doesn't mean go out and buy 10 tomorrow, but it means at some point you have to be able to identify 10 and not just one. And of course, I think that's what Jamie and I do in our publishing business, is try to help investors that want specific picks from all the research that we do. So those are that's a good starting point, I think. And that's why I wrote the book.
Yeah, which you can pick up at thegoldadvisor.com, thegoldadvisor.com. You can pick up a copy of Pay Dirt. And look, I may come across guys as I'm pushing, Jeff and Jamie's products, and I'm not, but what I am pushing is the value of community. And as if you're a regular viewer here, that's the mission behind this show, This Week in Mining, is that building a junior mining portfolio is really, really tough. Most people do get wiped out. So why do it alone? That's what we're here for, normally live every Wednesday. So you can hit the live chat, ask the questions, and let's do this together. Because let me give you an example. I don't have a great demeanor to be an investor. I'm too optimistic, right? I learned that early in my career. I'm more entrepreneur built. And so I'll look at a problem and say, oh, all we have to do is fix A, B, and C, and this will work. But as I began looking at deals with career investors, we would see the same thing. And where I would see a problem and say, oh, all they have to do is fix A, B, and C, they would say, there's not a chance I'd touch it because of A, B, and C. They would rush to the no, whereas I would try to find a way to the yes. And it took me years to develop that cynical muscle, right? And I had to surround myself with cynical investors whose mission at every pitch was to get to the no. And then in the cases where they didn't right away, that was something that would stay on the desk.
Hey, Jay, I sorry to interrupt, but I want to say, it's a great thing that you're saying we should build a community, and we should, whether someone subscribes to our letters or not. Building a community is great because we can all compare notes as long as we're honest with each other. Because think about this, our community is a gnat's eyelash on the hump of an elephant. I mean, our community is very, very tiny. And so while a lot of the rest of the world doesn't think like us, they're going to come into this sector at some point. Many of them will. And that is, frankly, what's going to push up a lot of our stocks, is when the mainstream, when Wall Street and Main Street and the generalist investor gets involved. That's what's going to push a lot of our stocks up. And getting educated and have a community before that is a great thing. So I applaud you for pointing that out, Jay.
Yeah, no, 100%. I mean, that's what worked for me. And so now we're doing that here on the channel. You hit on a really interesting point there. You said the first question you should ask the CEO who you're vetting is, what did the previous company's performance look like under your leadership, in so many words. And the second one maybe is, how many shares do you own? Right?
Yeah, exactly. You took the words right out of my mouth.
This has come up a lot. And, it came up in the last 2 episodes of this show. And I heard really interesting perspectives on this, where it's a really easy way to get to the no. The entrepreneur in me wants to say, but, maybe this is a young guy who hasn't made any money yet and they haven't been able to build a position. And except for that red flag, they're doing everything right. They're working tirelessly. They're surrounding themselves with good people. And maybe this is different, right? I recently looked at an opportunity that was brought to me by a good friend that I trust. The industry fundamentals look pretty strong, and I just couldn't get around the fact that this CEO owned very little stock. And the rationale explained to me was, no, they're taking a very small salary. They're very modest, they're not greedy. That's why. And I just thought, I just couldn't wrap my mind.
Wait, they have a little bit of stock and they're taking a small salary?
Correct.
Okay. That seems weird to me, right? Because those should be on either side of the teeter-totter there, right? It tends to be one or the other.
Because you want to see them incentivized, right?
You know what that sounds like to me immediately when I hear that CEO is a bag holder and he doesn't realize that he's a bag holder yet. That means
No.
somebody else, some promoter, probably in Vancouver, owns 10 million shares of that fucking thing, and he's about to spend $20 million on marketing and then blow out all those shares, and that CEO is not going to realize what happened to him until it's too late.
I am almost
Now, I don't know what
certain
company you're
that you're
talking about,
correct.
but yeah, that's what's happening there.
Well, and here's validation that you're probably right. When I asked, who owns the 38 million shares outstanding, I got a very non-committal response, and it was like, mainly retail, a couple guys that I know, and it was very it was a non-answer, right? And it was very clear to
Yeah.
me, not only do you not own very much, but you're not really sure who does, which, obviously, okay, easy to leach, right? Right there. Um,
Yeah, happens
I
often. That's
I
the
talked
thing,
to
right? It's like a lot of the CEOs, like they don't know what's happening to them here. Like this is, I think, what people don't understand is like people always assume it's like the CEO that's running a pump and dump or screwing them over or whatever. More often than not, that's not the case, right? Because the CEO is not the position you want to be in if you're running the pump and dump. Because the CEO is a reporting shareholder, the CEO can't sell his shares into the pump. So he's trapped. What you want to do if you want to run a pump and dump is you find a great geologist or engineer or some fucking likable guy that doesn't really know much about capital markets, but has some sort of reputable quality with respect to a mining stock and make him the CEO and pay him some great, whatever, $100,000 a year salary, but then you own all the shares. And then you're not on the board, you're not on the management, you get all the upside. No one knows you're involved. That's what happens to most of these CEOs. They're often as much of a victim here as a lot of the shareholders. And I don't think people always know that.
Well, no, I think most retail investors have no idea. I think you hit on something very important, and I want you to expand on that a little bit because it's a very real scenario in our industry and something that retail investors should be aware of and at least can look for. So we walk through one scenario that is a bit of a red flag there. I mean, it's a red flag for a handful of reasons. The CEO doesn't own much stock. That's curious. If they don't own much, why should you? It's an easy no. Jamie, that is a common scenario that, everybody knows the term pump and dump. I think most retail investors probably don't understand the mechanics of what actually occurs there. You guys understand how deals are structured. You understand why people win, why some people get screwed over. What could you arm my audience with in terms of insights beyond what you've already shared to,
Yeah. Okay.
miss
Let
that
me think.
trap?
It's hard. It's really hard because it's actually easy to hide, right? So people would think early on, like, okay, well, you just go to SEDI, SEDI, and you can find who the major shareholders are. Is anyone that owns over 10% of a company is a reporting shareholder in a Canadian company. That doesn't really work because what's pretty easy to just spread those shares amongst a bunch of different people, right? Like if I wanted to own less than 10% of a company, but I had 10% of the stock, I could put half of it in my wife's name and half of it in my name. If I had kids, I could put it in there. And it's easy to spread that share so no one's a reporting shareholder. So it's hard to catch them there. But the game of this business, of the promote business in Vancouver, is you don't buy shares, you find a way to create them. And there's two sides you can create shares on. You either create, well, actually, there's probably a third side I could think of. It's on the asset side, the business side, or on the shell side. So many of these companies are created by vending an asset into a shell. You've heard of things like a vend or an RTO, one of these things in Canada. There'll be a bunch of guys that have an asset and they want to list. And instead of going through the IPO process, they do an RTO, which is a reverse takeover, which means that company gets bought by effectively an empty listed shell. So some smart promoters will create shells well in advance of this, and they own all or most of the shares of those shells that are sitting on the TSXV or CSE or some other sort of venture stock exchange. And they built their position into that right away. And it's really hard. And then they'll acquire a company and they'll rename the whole thing and it'll become XYZ Gold. And no one will know that they already owned all that shares of the listed company, and will not have a 4-month hold period on their shares post transaction. So they'll be the only ones that can actually sell into the market at that stage. So that's the tried and true classic way to do that. the best way to see what's happening, okay, the best way to see what's happening there is what is the company buying the shell for? What are they valuing the shell at, right? Are they typically a shell will have some money in it. So if the shell has $5 million on it, but the company's valuing the shell at $10 million, that's like $5 million of created money, right? But now if they're have $5 million in the bank and they buy it at $5.5, $6 million, you're saying, okay, well, they're putting an extra $500,000 on there. That's kind of what it costs to list a company anyways. And like maybe you're paying a little bit more to expedite. That's less egregious, right? So the number one thing I would look for is, are they paying a massive premium for a shell? Meaning, is the acquiring company being valued more than it is objectively worth? That's number one. On the asset side is very hard. It's very hard to know who owns what. Most of the time, it's all been done privately. It's almost impossible to know what's happening. But another way you can tell that promoters are getting positioned in things, or people, is if they acquire a bunch of other assets that are non-core assets that are like kind of like peripherally involved, like, oh, you know, we're going to get some other lithium thing over and some blah, blah, blah grassroots thing. Often they're just acquiring these assets that are owned by someone they want to position in the stock. They know they're never going to be able to, or never going to want to explore or drill or whatever it is they say they're going to do on that property. They're just getting it so to give somebody else shares. So like these kind of random ass acquisitions that are like non-core properties, that's another thing to look out for. I'd have to put some more thought into this. There's a lot of different tricks that people can do that you have to kind of really keep an eye out. And if you're here in Vancouver, I know people that have done all these things. I know companies that have done this. So I know how it works because I know people who've done it. But it's super hard to find this information if you're not in it and you don't know what's going on. It's like there's no book written about this. There's no resources for this.
No,
to learn this.
But thank you for expanding on that, because I think it's really important for investors to realize that that's a real scenario.
Yeah.
And you know, that the other way to approach this might be, honestly, the way I approach it, which is kind of what Jeff shared as his initial qualifying question to a CEO, is that I begin with people over everything every single time. And by just isolating a small percentage of entrepreneurs, executives, advisors, and sticking with your small team of professionals in the business who have a track record of doing what they say they're going to do, creating shareholder value, having a plan C when plan A and B fail, because it's probably going to, or it's likely, and they have the resilience and energy to hunt down plan C and keep protecting your shareholder dollars till they get to the finish line, or do their damnedest trying. That is the other way to safeguard against that, because you just know you're in good company, and good company typically keeps good company. Jeff, any comments on that?
Well, yeah, I think if you focus on the top 10 people, if you want, or top 20, whatever that may be, that's Rick Rule's formula, right? If I just invested with my top 10 people, I would have made more money and had less stress. So that's one way to do it. And you should focus on, the top people. So one thing I'll point out about what Jamie was saying is those tactics aren't just beholden to the junior mining sector. They're in every industry. They're no matter where you invest. If you're going to invest in individual stocks in some industry, it is probably happening in that industry as well. It happens in S&P stocks. Probably the biggest competitor for our industry would be the pre-pharma stocks, the ones that are in the experimental stage and things like that. So you can bet your bippy that's happening in that industry. So it happens a lot. You want to be aware of it. And like Jamie says, it's going to be impossible to always track this stuff down. But your buffer against that is having a system that you're going to stick with, meaning the top people in the top jurisdictions with projects that are a go big or go home type of thing. If you just did that, you would be ahead of 90% of retail investors out there. So I think it's worth it. I'm investing heavily right now in juniors because of what I said earlier. I'm afraid this market's going to take off, and at some point it will. I don't know if it's next month or next year, but history tells me that this is going to happen. So I'm positioning fairly heavily now in this sector to benefit what I think is going to be huge in 1, 2, 3, 4 years. Who knows how long from now?
I want to pull on that thread a minute, Jeff. So Jamie shared he's looking at the developer stage right now for his reasons. You're looking at juniors. Can you elaborate a bit, junior? How junior do you like to go right now? I think I know, but I'd love to share with my audience.
Well, we do have developers in the portfolio, and Jamie's right. They're very undervalued, and they have value there right now. We do focus a little bit more on the pre-producer, the one that's actually in construction, because there's a re-rating that can be reasonably expected over the next year or two for those companies. And juniors that already have a resource and they're looking to expand that resource. And then I have a fair amount of pre-discovery plays where it's basically looking for a discovery. And when you get down that far down the ladder, it's really important you stick to whatever strategy or rules you're going to have, because that's your riskiest play, right? Is the pre-discovery play. So it's really important you have people that have been through this before in pro mining jurisdictions, and that have projects that can be big. They may not be big yet, but they have the potential to be big. So that's where we're focused.
Okay, I appreciate that. Now I want to push people to both of your sites. So Jeff, the pay dirt prospector, still at thegoldadvisor.com, correct?
Yeah, it's still thegoldadvisor.com, but it's actually a new paid letter that we just started in January. I was having picks that I was seeing companies at conferences like VRIC, for example, of companies that I would like. And on mining tours and in other conferences, and like, wow, I'd like to recommend that. I'd like to recommend that. I think I'm going to buy that. But I had no avenue for that because the Gold Advisor site is more conservative, right? But if you're going to have riskier stuff, you really shouldn't put that on a free site. And that's what led to Pay Dirt Prospector, which is the paid newsletter. I got to be honest, I'm having a lot of fun with it. It's a blast. I wake up every morning and can't wait to see what I'm going to be writing about that day, whether it's in the Gold Advisor, the free site, or in the paid newsletter. But I will tell you, I'm going for it. I am going for it in Pay Dirt Prospector. This is my personal portfolio. If I don't own it, I give people a chance to buy first. But I'm going for it in that newsletter, because I saw what happened in 2008, the huge bounce we had. I vowed I wouldn't miss out on that opportunity again. So in 2020, the COVID crash rolled around. I bought hand over fist. As scary as it was, I bought hand over fist. And by the end of the year, my portfolio was up. My entire portfolio was up 4x. So, I love big dips, and I cannot lie. That's my theme when it comes to big crashes like that. So, but history tells me that I need to be long here. And so that's what I'm focused on. And I do expect to have see some very nice gains in there before all this is over.
One more reason to go in with somebody like Jeff or Jamie on your team is because you realize that 4x gain if you're so lucky to be right, but then you're faced with the harder part of the trade, which is when to sell, right? And how to sell.
You know how you sell is the same way you buy. We buy in tranches, right? So at least I tell people to buy in tranches. That's a good way to kind of ease in and build a position. We're going to sell in the same way, in my opinion. We're going to sell in tranches because we'll never know when the top is, just like we don't know when the bottom is in a stock, right? So we'll be selling in tranches. I think there's a reasonable chance we'll get a mania in this sector at some point, especially gold and silver. And these stocks could really run then. It's going to be very tough to know when the top is in. There'll be some big drawdowns, then a run back up again. So selling in tranches is going to be the way to go, I think.
I like that. It's a realistic approach. Jamie, same question over to you. You're at resourceinsider.com. What can people find on the site and behind services?
I mean, most people can't buy my newsletter, and even fewer people probably should buy my newsletter. So we only sell our newsletter to accredited investors. We primarily focus on private investment opportunities and private placements in the public market. So our subscriber list, the people we work with, tend to be very high net worth individuals. We have some trading firms we work with. We have some small institutions we work with. I fill a very specific role in the market. I look for two things: cash flowing commodity businesses. So we've bought frac sand terminals in the United States. We've invested in cash flowing oil and gas companies. We've invested in carbon credits, and we've also take positions in high risk commodities. These are the gold exploration stocks. This is copper development in Colombia, things like that. The vast majority of what we've done over the last 2 years has been in private businesses, most of which are planning to list in the medium to longer term. And so that's our niche. We focus purely on that. That's where I put the majority of my money. That's where I would say, expert, and I like to stay in doing what I want. So for most people, that is not a good fit for their investment portfolio. But for people that are looking for private cash flowing businesses and very sort of early stage investment opportunities in natural resources, and I don't necessarily mean early stage in terms of exploration, I mean inception of new companies, and the focus on that, that's where we've really kind of built our expertise and had a lot of success. So if you're interested in that, you can go to resourceinsider.com.
Okay. Look, I appreciate both of you gentlemen. Thanks so much for coming on the show. I very much appreciate your time. For everybody who tuned in, thank you. I love you guys. I love the supports as we grow this community of junior mining investors. Let's ride this market together. We're here every Wednesday at 2 p.m. Pacific time, 5 p.m. Eastern time, right here on the VRIC YouTube channel. New guests each week just to sit here and jam on the industry and jam on our portfolios, to answer your questions in the live chat. I will see you next week live Wednesday at 2 p.m. Pacific. I look forward to it. Thanks so much, everybody.